Well, welcome everyone, and thank you for joining us today. I'm Kieran Osborne, the Chief Investment Officer at Mission Wealth, and it's my absolute pleasure to introduce Dr. David Kelly, the Chief Global Strategist at JP Morgan Asset Management. By way of introduction, Dr. Kelly has over 20 years of experience and provides valuable insight and perspective on the economy and markets to many institutional investors, financial advisors, and their clients. He has written extensively on all aspects of the US economy, and his proprietary economic forecasting model helps shape his views on both the economic landscape and the outlook for asset class returns. He is a keynote speaker at many national conferences, and you may have seen him on CNBC or Bloomberg TV, where he is a frequent guest, and he has been widely quoted in the financial press. At Mission Wealth, we've had the benefit of Dr. Kelly's expertise for many years. His insights are incredibly valuable in helping formulate Mission Wealth's own outlook for the economy, financial markets, and asset class returns. We're extremely thankful for our partnership with JP Morgan and are excited to hear David's insights in such a dynamic market environment. We had a number of questions asked ahead of time, so we'll cover a lot of those topics after David's prepared remarks. So with that, it's my pleasure to hand it over to you, Dr. Kelly.
Great. Well, thank you, Kieran, and thank you all for taking time this morning to do this. So what I'm going to do here is I'm actually going to share my screen. So let me see if I can get the technology right here. So I'm going to do a little screen share there, and then I'm going to bring up my presentation. So what I want to do is maximize this. What I want to do is take about 25 minutes or so, maybe half an hour, to try and lay out how we see the economic and financial environment right now. And then, Kieran, I know you've got some questions and people have sent in some questions, so I'll be happy to try and address those. I think the key thing I would say is it's important to recognize that we are gradually getting through all the waves that COVID have caused in the economic environment. This is an economy that is gradually slowing down. I think it's also an environment which inflation is slowing down. So we're in a reasonably good position here in terms of the economy. But I think the good news is going forward, I think we're heading back towards a slow growth, low inflation, low interest rate environment, which really was very good for financial assets in the last decade before the pandemic. The risk is, of course, that we are talking about very slow growth. And there are a number of things that could go wrong that could put us into recession. And so I think it's important because of that people stay very well diversified in this environment. So bearing all of that in mind, there are a few things I want to talk about today. First of all, I want to talk about economic growth and why we see a soft landing so far. Then I want to talk about inflation and why we are really convinced that inflation is in fact heading back towards 2%, and we should get there before the end of next year. I want to talk about economic growth around the world, which has slowed down right now, but ultimately I think the rest of the world will grow faster than the United States. I think the US dollar will come down over the next few years, which should amplify the return on international investments. And then finally, I want to talk about investing beyond the cycle. I think it's important not to try to make too many short-term calls about how markets are going to behave over the next 3 months or 6 months, but really think about what assets are best positioned for the kind of environment that we're going to see after the economy has fully worked through its current sort of inflation economic growth cycle. So those are 4 things I want to talk about, but let me start with economic growth. Now, we just got some new numbers this morning. And by the way, all these slides come from our guide to the markets. And so if you see some strange page numbers up in the top right, that's what they refer to. We've got some new economic numbers today on GDP growth, and they revised down second quarter GDP from 2.4% annualized growth to 2.1% annualized growth. And you can see that in this little box here. But that still is 2.5% year over year, and that's really good. And in fact, if you look at this chart here, if you go back over, back to the start of this century, we've seen periods of above trend growth, below trend growth, but generally the economy's been growing on average at about 2% pace, and we're pretty close to the trend line. We're pretty close to where we should be, even if we had not had a recession. Having said that, there is, we do think the economy is going to slow down. Now, the third quarter GDP number, for what I think are almost technical reasons, is going to be strong. But if you look at the underlying trend in things like borrowing from the banking sector, if you look at consumer spending trends, if you look at employment trends, we do think the economy is slowing down. What I think is important to recognize, though, is that we are not in a recession right now, and we seem to have avoided a recession to this point. And there's certain things which seem to be protecting us to some extent from recession right now. So what's protecting us? Well, the first thing, and perhaps the most important thing, is that there is no cyclical sector of the economy that's overbuilt. This chart here, which is page 20 of our guide to the markets, shows, let me just put this down here. This shows the cyclical sectors of the economy. You can see, let me just put this all the way down here. So we've got home building, we've got business fixed investment, sometimes called capital spending, we've got light vehicle sales, we've got inventories. And normally when you have a recession, one of these sectors goes from boom to bust. For example, in 2006, we had a huge boom in the housing market and it went bust. This time around, we had a much smaller boom in the housing market. And yes, home building has fallen, but really it's first of all, it's already low as a share of GDP, and it didn't fall that much because it never got that high. If you look at business fixed investment, you have to go back to the dot-com bubble back in the late 1990s and in 2000, and you could see how that crashed and put us into a recession in the year 2001. This time around, investment spending, business fixed investment spending isn't nearly as high, and actually it's proving to be fairly resilient because of, I think, two things. First of all, you've got a lot of excitement around AI and data centers, and that's causing a lot of investment in that technology. And second of all, you've got the effects of various pieces of legislation, such as the infrastructure bill, the Inflation Reduction Act, which is really very much focused on green technology, and then we've also got the CHIPS Act, which was really encouraging a lot of investment in chip production in the United States and in manufacturing various components for the technology industry. These things are helping business fixed investments stay relatively strong here. If you look at light vehicle sales, they picked up recently to 15.7 million units right now, but that's not high. In the 5 years before the pandemic, the average light vehicle sales number was over 17 million units. So you can't say that that's overbuilt. And then if you look at inventories, we're really right on the normal line in terms of inventory sales ratios. So there is no boom to go bust. It's very hard to injure yourself badly falling out of a basement window. And that's kind of where a lot of these cyclical sectors are. The second thing that is really helping us is an extraordinary level of job openings. Now, this chart here on the left, which looks a little bit like the Loch Ness Monster, this is job openings going all the way back to 1973. Now, the government only publishes data going back to the year 2000, but because this series is very closely correlated with another series that is put out by the National Association of Independent Businesses, we're able to synthetically recreate this series going back to the 1970s. And what you can see is we have never had a level of job openings like the level of job openings that we had when the pandemic faded. So we got up to 12 million job openings in March of 2022. Now, we just got a new number on job openings yesterday, and you can see just how much they've come down. They revised down the prior month yesterday, and they brought down the most recent, and the most recent month was lower than people expected. So we're down from 12 million units to, or 12 million job openings to 8.8 million job openings. But I would point out that the highest number that we ever saw before the pandemic was about 7.5 million job openings. So we're still well above that level. We can see that the number of people voluntarily quitting has come down. We can see that the number of people getting laid off has gradually been trending up. So the labor market is normalizing, but we've still got this excess demand for labor. It's very hard for the economy to fall into recession when so many people are anxious to hire people. Now, it gives you a level of immunity, but like immunity to viruses, the immunity fades over time. So by, say, this, early 2024, I don't think this is going to give us any immunity anymore. I think you could still have a problem, but for the moment, this is helping us out, and that's really why all these worries that we'd fall into recession this year. It's why it hasn't panned out that way, and why the economy is still moving forward. Having said all of that, we still think the economy is going to slow down. So why is that? Well, part of the issue is consumer spending. So this chart here goes back to 1960. It looks at the personal saving rate as a share of disposable income. It's kind of the opposite of consumption. You spend the money or you save the money. And what happened was, I arrived in America in the 1980s, and already people, Americans were legendary for their ability to spend money they didn't have on stuff they didn't need. And all through the 1980s and 1990s and into this century, Americans overspent. They kept on pushing down their personal saving rate, which really meant they were spending more than, or their spending was growing faster than their income. That reversed to the great financial crisis. And so in the years leading up to the pandemic, the saving rate is about 7.5%. Then it shot up because of all this money handed out over the pandemic. And so you had all this income and not so much spending. And what's happened in the last year or year and a half is a lot of lower and middle income households have tried to maintain a level of spending which they were able to do during the pandemic, but which they will not be able to do going forward. And so you saw the personal saving rate come right down to very low levels. It's at about 4.3% so far this year. So it's still much lower than average. And I think that's, people are paying more on their mortgage, they're paying more on rent, they're being forced to sort of dig into savings or pile up credit card debt. And that's what they're doing a bit, but they cannot do it forever. And so what we're seeing is a squeeze on lower middle income households, which is going to get worse as student loan repayments pick up. And that's one of the things that's going to slow down consumer spending. There are other issues. I think there is an issue, which I think everybody in this call is very well aware of, in the banking industry. You saw the failure of certain regional banks earlier on this year. And one of the problems that we're particularly concerned about is regional banks have a huge exposure to commercial real estate, and all those empty office buildings, a lot of retail space that just isn't built for purpose at this stage. We're going to see, and we are seeing leases not get renewed. We are seeing loans go bad, and that is gradually eroding the balance sheet of these regional banks, and also higher mortgage rates, higher interest rates are reducing the value of securities for these regional banks. And what it's doing is it's causing the banking industry itself to get tighter and tighter on credit. So there's just not as much credit being issued. And that is going to slow the economy down, even if we don't have another banking crisis. And we could have another banking crisis. We're also very concerned about bank deposits. Now, they seem to have stabilized since this spring. But overall, when you can make better money on money market funds, people are inclined to take money out of the banks, and that could force the banks to further pull back on lending. Also, I would say that there's something of an issue on inventories. Remember, if interest rates are zero or close to zero, it's not that expensive for a business to borrow money to pile inventory into their store, onto an auto dealership or whatever. The floor plan's just not that expensive to finance. But with interest rates higher, it gets much more expensive to finance. And so I think that you're going to see much more, and you are seeing much more cautious business behavior in terms of borrowing money, and that will slow the economy down. And then the third thing I would say, and perhaps this is the more important point for a long-term investor, is eventually we're going to have a recession. And the reason I say that is because look at the unemployment rate. It's down here, 3.5%. It actually has hardly budged over the last year. But you go back historically, just before the pandemic, okay, that was a little bit unusual because the pandemic couldn't have been forecast. But if you look at what the unemployment rate was doing just before the great financial crisis, or back for the dot-com bubble burst, or back in before the 1990 recession, the unemployment rate gets down to a certain low level, but when it's at that low level, it's actually vulnerable, because what happens is at that low level, you can't find more workers. If you can't find more workers, the overall employment can only grow as fast as the sort of working age population, more or less. And that slows economic growth down from, it's not 4%, it's not 3%, it slows it down to below 2%. And it's kind of like riding a bicycle slowly. If the natural growth rate of the economy is only 2%, one shock, one big banana skin, you can end up in a recession. And so I think the way I would put it right now, to be very specific, is I think the risk of a recession starting this year is less than 50%. I don't think it's going to start this year. I think if you take it out to the end of next year, the chances are about 50-50 of a recession starting before the end of next year. And then if you take it out to the end of 2025, it's more likely than not that we will have a recession. And it's simply because of a cumulative probability. You're not going. You just as you stack these quarters, quarter after quarter after quarter, it only takes one bad thing to happen to take a very slow-growing economy and turn it negative. And I think that's where we are in terms of growth. But I do want to emphasize that when we say recession, how are you supposed to think about that as an investor? The first thing I'd say is don't expect a big recession. So this chart over on the right here looks at it's sort of our solar system of recessions. You can see the Great Depression back in the 1930s, obviously dominating the picture as being the worst recession by far. But then if you go forward, you had some interesting GDP numbers around the wind down after World War II, but it's not really significant as a recession. But if you look at what happened in the Great Financial Crisis, you had a very big recession, as we all know. The pandemic recession was very big, but very short. But if we have a recession going forward, we think because of the situation in the economy, it's going to be a mild recession. It's going to be much more like, see this little recession in the year 2000, or this one, or in 2021, this one in 1990 to 1991. These are small recessions. This is much more likely to be what we're going to see in a recession. It's sort of a Mercury or a Venus of a recession as opposed to a Jupiter. The other thing I would say is, how much should you prepare for a small recession as opposed to a big one? The other thing to, of course, bear in mind is, as a long-term investor, everybody wants to know when there's going to be a recession. But the truth is, this is an economy of long summers and short winters. This chart here on the left shows the length of expansions and the length of recessions in the United States, measured in months, going back to the 1920s. And you can see the expansions are much longer than recessions. And what's more, the expansions have actually been getting longer over the years. So I think it's important to keep any future recession in context. It's not likely to be like the last two. Let me talk a little bit about inflation. This chart here shows inflation going through really from its peak or close to its peak in July. It peaked in June of 2022, but it's come down now. It peaked at 9.1% year over year. It's down to 3.2% year over year, and you can see that it's come down pretty steadily. Now it did bounce in July relative to June, and that really had a lot to do with the fact that that July of last year had less inflation than June did. But a lot of, I still think this inflation is going to come down further. And the Federal Reserve sort of worries about, okay, well, it's not food and energy anymore, because here's energy prices, and you can see energy prices are actually negative on a year-over-year basis. And if you look at food at home, that was a big contributor to inflation in the past, but not so much now. But what the Fed says is, well, let's not look at food and energy because that's sort of globally determined. Let's look at what's going on in the United States and look at wages, because we think that wages may be pushing up certain parts of inflation. So, there are really two things. They recognize that shelter, which is very sticky, and that may keep the overall measured inflation rate high, but that is based on rents and is kind of a technical issue rather than a real issue. In real terms, from an inflation perspective, rents are very high, but they've stopped rising, and we know they've stopped rising, and they're going to fall, and that means that on a lag basis, that's going to lead to lower inflation. But what the Fed is fixated on right now, and you could see this when Chairman Powell was talking last week in Jackson Hole, what they're fixated on right now is core services inflation outside of shelter. And what Chairman Powell says is, well, that's because wage growth has been high. That's pushing up all the price of all these other things. But if you actually look at it, and this is core services ex shelter, and you look at this inflation rate, and one thing sort of jumps out at you, I think, which is, well, what's this big red blob here? And that red blob is transportation services outside of aircraft. It's actually auto leases, auto insurance, and auto repair and maintenance. And those costs have been shooting up double-digit rates because auto prices went up very sharply during the pandemic, and now you're having to repair or lease or insure much more expensive vehicles. That's really what's been going on here. But we know that vehicle prices have also stopped rising. So with a lag, this is going to go away. So the point I'd make is, there are plenty of things to be worried about, but I'm really not worried about inflation. I do think inflation is coming down. It's kind of like a roller coaster. You can see it here up and down in the 1970s. And then it was coming down for a long, long period of time. And then up and down this time around. But you notice when it goes up and down, it's actually very symmetrical. It looks a bit like the Eiffel Tower, goes up and then comes down. And what's more, I strongly believe that it's kind of like a roller coaster in that no matter how crazy the roller coaster is, you actually get off where you got on. We got on at 2% inflation. I think we're getting off at 2% inflation. Yes, food and energy prices will come back down again. That's really based on the global economy. The global economy is relatively slow right now. Shelter is going to come down because we know the rents have stalled out because people frankly can't afford to pay the rent. And there is more property coming online in terms of multifamily housing. But also wage growth is, it is higher than it was. And let me pull back and talk a little bit about wage growth here. Actually, I think this chart here, you see this blue line is wage growth. You can see that it is higher than it has been on average over the last 50 years, and it is higher than it was before the pandemic, but it's actually been coming down over the last year. And what I think that indicates is that workers, no matter how dissatisfied they are with wages, they're really not that organized. Only 6% of American private sector workers are in unions. And so they're not actually, even though you read about strikes, there aren't that many people who are quitting because they're not getting the raise they wanted. And so that is controlling wage costs. And if it does, I believe inflation will come down in the long run. So in the long run, the thing to look at is this decline in inflation we saw from the early 1980s to the late 20-teens. That was because of a decline in union power. It was because of it was because of greater information technology, which I think has made a lot of markets more competitive. It's because of increasing income inequality. And there has been a huge increase in income inequality, which tends to direct money and divert money towards purchasing financial assets as opposed to goods and services. And of course, goods and services is what we measure in terms of inflation. So I believe that inflation is coming down, whether or not we end up in recession. Which brings me to the Federal Reserve. Right now, you saw that Chairman Powell made a somewhat hawkish speech in Jackson Hole last Friday. He talked about how the Fed still thinks inflation's too high, thinks the wages are pushing up inflation, worried that growth is too strong. But still, they recognize they pushed rates a long way. And as of this morning, after we got that GDP report, markets are pricing in about a 14% shot that the Federal Reserve will raise in September, and about a 48% shot that they will raise rates either in September or in November. And that is down from where it was just after Chairman Powell's speech. And I think that's about right. I think it's very close call as to whether they will raise rates again. I don't think they should raise rates again. I think inflation's coming down anyway. But we are more optimistic on than the Federal Reserve on getting inflation down. We think, if you look at the Fed's forecast, they think that PCE inflation, this is the number they look at, PCE inflation, they think it'll be 2.5% by the fourth quarter of next year. We think it'll be below 2%. They also think the unemployment rate will be up at 4.5%. And if they can just avoid overdoing it, I think we can keep that number below 4%. So overall, the Fed is still very hawkish. If we don't end up, I think they're almost done though. So it's a coin flip as to whether we get one more rate hike or not. If we don't have a recession, or until we have a recession, I think the Federal Reserve will slowly lower interest rates next year. So maybe reduce rates by 0.25% per quarter. If we do have a recession, they'll cut rates more rapidly. Remember, in the long run, they think the federal funds rate ought to be 2.5%. Right now, they've got a rate of 5.25%, 5.5%. So we're a long way from what they think is normal. And if they think the economy is in trouble and inflation is not a problem, they will cut rates more aggressively. But if they don't think the economy is in trouble, it's going to be a slow fall in rates next year and in 2025. Just briefly looking at the rest of the world, because I want to make sure we leave time for questions. Overall, if you look at this is a PMI heat map. It looks at both manufacturing and services around the world. Green is good, red is bad. You've got some developed countries up here, and then you've got some emerging markets down below. You can see that the numbers were relatively green in July, but they've weakened in August. And we think that's interesting. We don't show Chinese numbers because the Chinese do not release flash PMI data, but we think that things are slowing down more in China. The Chinese have got a terrible problem in that the public likes to save money, and they've sort of lost confidence in the housing market and lost confidence in the government. And so they're saving and not spending, and that's slowing the economy down. We've also got weakness in Europe, which is a little harder to explain, but we are seeing weakness in manufacturing in Europe. The US is doing okay. Japan is doing very well. India is doing very well. But overall, I'd have to say the global economy is a little soggy. In the long run, we do think the global economy will grow faster than the US. And I think that is important because we're running out of available workers, and that it should allow the rest of the world to grow faster. But for the moment, the whole global economy is a bit soft. And I think that does, I think that reduces inflation pressures overall. One other thing to talk about is this is what the Federal Reserve, what people think the Federal Reserve will do. This gray line here, those are short-term interest rates. And the Federal Reserve has rather bizarrely said that they're going to push rates too high and then bring them down over the course of 2024, 2025. The European Central Bank has not said that. They're still pushing rates up. They may not push them much further, but they're not going to ease so aggressively. The Bank of England, same thing. The Bank of Japan has not begun to raise rates right now, but rates are going up rather than going down. So going out, and this is important for financial markets, going a few years out, it looks like the big gap that exists between US interest rates and everybody else is going to narrow. Now, why would that be important? Well, it's important because of what it means for the dollar. The dollar got very high. Basically the dollar rose all the way from about 2008 all the way up to September 2022. Since it's fallen back, and this year it's been kind of oscillating because people know it needs to come down, but the US economy is doing relatively well, and the global economy is doing relatively poorly. I do think that over time, the dollar will come down some more, and that should amplify the return on international investments. Okay, let me talk a little bit about some opportunities here. So year to date, and these numbers are as of August 29th, so as of essentially yesterday. If you look at year to date returns, very good returns in US equities, on DM equities in general outside the United States. Fixed income has had a tougher time. It is positive. Commodities have been negative. But overall, you have to say it's a pretty good year. And that really has an impact on how we feel about investing. This chart here shows valuations across different asset classes. And the thing we like about this is it's a way of comparing valuations, looking at apples and oranges and bananas at the same time. So we look at a whole lot of different assets like treasuries or municipal bonds or EM equity or US value stocks. And what we say is, well, what's the most important valuation metric we use? For US equities, it might be forward PE ratios. For treasuries, it would be the yield, technically what's known as yield to worst. And if we look at what we say is, well, what's the average level of that valuation measure? And then what's one standard deviation around that? And then what's two standard deviations around that? So how far from normal are we? And the green diamonds are where we were at the start of last year. And everything was pretty expensive. The green circles, the dark green circles are where we are right now. There's a lot of stuff that's cheap, But you will notice that US high yield bonds and US large cap stocks and US growth stocks are somewhat on the expensive side. So I think we have to pay attention to that, even if we feel relatively optimistic about the economy. In the bond markets, what we show here is some high quality bonds over on the left, and you can see that yields are very high relative to what they've been historically. We think there's an opportunity there. We're a little bit more nervous about things like high yield, where you're not really getting compensated for the risks you're taking. The yields are high, but they're not that high given the risks that are out there. And so we would tend to be relatively high quality and maybe long duration in the bond market, recognizing that sooner or later the economy is going to slip on a banana peel, the Fed's going to have to cut rates, and you're going to get a return on long duration fixed income. For the stock market, earnings are doing surprisingly well in 2023. And I think this says something about the whole nature of this US economy. I mean, this is a tough year for US businesses. You've got consumer spending growth slowing down. You've got very high interest rates to contend with. You've got a lot of concerns out there about the state of the economy and about how to borrow money. And yet companies are finding ways of making money. And I think I think that shows the ability of companies to push back on workers, to get better productivity gains, and to push back on wage demand. So profits seem to be doing reasonably well. We're up, we think now, about 12% year over year for this year. Still not like we did had in terms of profit growth back in 2021, but really not bad, all things considered. For US equities, I would say valuations do look elevated. This is normal. About a 16.8 times PE ratio. This is where we are right now, about 18.8 times. So I'd say it's above average, but it's not extremely above average. And given the performance of US companies in maintaining margins, I don't think it's completely unreasonable. There are cheaper things out there. I think international equities are a lot cheaper. You can see, this is looking at a slightly different metric because we're looking at the 4 PE ratio for I believe it's, even though this says this is from July 31st. So we're looking at a PE ratio for the S&P 500, which is a good deal higher than for around the rest of the world. In fact, this chart here shows that the ratio of PE ratios between the rest of the world and the US is much lower right now. You basically can buy $1 worth of future earnings at a 33% discount in non-US markets relative to the US. And the dividend yield is about 1.6 percentage points higher overseas. So it is important, I think, to have international equities in a portfolio. I think it's also important to have alternatives in a portfolio. You could see, I think inflation is coming down, but one of the things we saw last year is if inflation goes up for whatever reason, the bond market gets hurt, the stock market gets hurt. What does okay? Real assets do okay. I think it's important to be very broadly diversified, have international, have alternatives in a portfolio. I think it's okay to be optimistic about the economy, but still be careful about how you allocate in this environment. And finally, I would say, in terms of attitudes, this is in some ways the most consoling or comforting chart we have in the guide. It looks at consumer confidence and the stock market. And it's actually remarkably good at predicting how the market's going to do if you buy at an extreme. If you buy when people are feeling extremely good, then on average, you've only had a 3.5% return on the US equities over the next year. If you buy when people feel extremely bad, you've done about 24%. Now, where are we right now? We're not at the extremes we saw in June of 2022, when people felt absolutely miserable. And by the way, they had a great return in the following year. So not quite there, but we're well below average. I think people still feel very gloomy, very worried about the economy. And that means that as people feel more comfortable about it, they ought to put money to work. That ought to help equities do well. So overall, I don't believe in trying to time the market. I think it's really important to think about what you own and to have a plan that is appropriate for where you are in life. But overall, I feel pretty good about where we are in the economy. I think that we are going to head towards slower growth, but it'll be slow growth with low inflation. I think that should be supportive of a lot of financial assets. I think the dollar will come down over time. That should be supportive of international assets. But I also think that there are risks out there. There are always risks when you start with a full employment economy. And because there are risks in a full employment economy, I think it's very, very important to be diversified. and to sort of protect yourself, not just against the, what we know is likely to come, but really the things that we never expect to come. Because if there's one, hallmark of this century, as far as I'm concerned, it is the ability of the whole global economy, financial markets, to get whacked by something nobody ever saw coming. So those are the main points I want to make. I'm sorry I went a little long there, but now I'd love to open up for any questions.
Now, that was fantastic, David. That covered a broad range of topics, and I want to dive into a few of those topics here through the Q&A session. With a backdrop of relative resilience in terms of economic growth, data points, economic data points have really surprised to the upside broadly through the course of the year, and then economic growth projections have been revised higher as well. So with that backdrop, what does it mean for Fed policy? We've got a pause likely on the horizon. Maybe they raise, maybe they don't. It's a coin flip, as you alluded to. But do you anticipate them cutting rates through the course of 2024? And not to overcomplicate things, but we do have an election year around the corner. Does that play any part or have any impact into the way that the Fed may think about that? And then on a related topic, we've had a number of questions around rates and the yield curve. Do we anticipate, or do you anticipate that the yield curve will stay inverted through 2024? What do you expect in terms of interest rate dynamics, especially say the benchmark 10-year?
Yeah, so I think three questions there. The first one is, I think the Federal Reserve will cut rates next year, even if the economy is still growing, but they're not going to cut them in a hurry. So I think that they may be, if we get, I think the CPI inflation number will be a little hot for the month of August, but I think that's got to do with a temporary increase in gasoline prices. And so long as gasoline prices look like they're coming down, I think the Fed will look through that, recognize that shelter inflation and perhaps other areas of inflation are improving, and back off. And I think that because I think what's going to happen is core CPI and the core consumption deflator, which they actually spend more time looking at, will show signs of easing. So I think they'll hold off in September. They'll probably have another reason to hold off in November. It's a close call, but I think they may be done here. Whether they are or not, and it's either they're done or we get one more rate hike. What Jay Powell has said at his last press conference after the last Fed meeting is that the Federal Reserve will begin to cut rates before, so long as they think that inflation is just about to hit 2%, they will begin to cut rates. And because he recognized that there are lags in the way monetary policy operates, if you actually want to coast into 2%, you have to cut rates before you hit there. Now, having said that, I think that the Fed is usually late to the game. So if I had to bet, I'd say they're not going to cut rates in January. Maybe they cut rates in the middle of March next year by 25 basis points as a sort of a down payment on recognizing that inflation is coming down. That's all, and I think that's what they'll do until we have an actual recession. If you get two negative numbers on payroll employment, all bets are off. But for as long as the economy remains resilient, I think that's what happens. With regard to an election, the Federal Reserve tries its darndest to stay out of politics. That's one of the reasons why they always time their meetings so that the meeting that would have to be in late October, early November, actually turns out to be a few days after Election Day rather than a few days before Election Day. And that's going to happen this year too. But I think that first of all, I think they would like to keep out of politics altogether, and they don't want to be causing a problem. But equally, I think they, at the back of their minds, they don't want to cause a recession, for this administration or really any administration to deal with. They're not getting the same amount of blowback under the Biden administration that they got under the Trump administration. But either way, they just don't want to, they don't want to be the cause of political decisions one way or the other, or have an impact on the 2024 elections. And then on the yield curve, I am suspicious of the yield curve. The yield curve, people have traditionally said, is a great predictor of recession. Indeed, if you look at, say, the spread between 2-year notes and 10-year bonds, when that turns negative, that has been a harbinger of recession in the past. In fact, in five of the last six recessions, that turned negative about, on average, about 15 months before the economy entered recession. It didn't quite turn negative on a monthly average basis for the pandemic recession, but I don't expect the yield curve to predict viruses. But having said that, people are very worried because it has been now negative or inverted since since March of last year, maybe I think it's June if you look at the 2s to 10s, but it's been for over a year we've had an inverted yield curve. And so people think, well, doesn't this mean we're headed for recession? And as I talked about before, every recession is different, and this economy has got some unusual sources of resilience in not having overbuilt cyclical sectors, and in having such a pent-up demand for labor. I think it's also got a certain resilience in the fact that the housing market was never too strong before they started raising rates. There's a limit to the economic damage they can do. And because so much of investment spending these days is not really building big factories, it's R&D and software and paying the people going up and down the elevators. And that doesn't usually involve borrowing money. So the economy is less interest sensitive than it was. The other thing I would say is that inverted yield curve, it may reflect the fact that the Federal Reserve is being very open in saying that they're overshooting and rates are going to bring rates down. They've never given us that information in the past. But if they're honestly telling us that in a few years' time, the federal funds rate is going to be 2.5%, and we know that today it's between 5.25% and 5.5%, then of course you'd be willing to accept a lower rate on long-term bonds and short-term notes, because the short-term notes you're not going to be able to reinvest. So at those rates. So I think the yield curve may be lying to us somewhat here. Now, having said that, how are things going to play out? I think if the economy avoids recession, you will see a slow decline in the federal funds rate next year. So right now we're 5.25% to 5.5%. I think by the end of next year, we might be 4.25% to 4.5%. The 10-year Treasury yield running about 4.1 today, I would expect it to come down a little from there, because I think we're going to get better inflation news than the markets expect. So maybe we're at about a 3.5% to 3.75% rate if we avoid recession. But again, if the chances of having a recession increase as time goes on, and as soon as you have a recession, I could easily see that long-term rate plow down below, down to 2.5% and maybe lower than that. So I think that it's not really. I don't think it's a symmetric risk. I think right now, very unusually, you can actually get a decent income from fixed income with the possibility of a capital gain going forward. It's kind of, I write something on LinkedIn every week, and I was writing something about how it's a little bit like owning the railroads of Monopoly. I mean, it's kind of a boring income you get, but every now and then somebody hits the chance card, which means that you have to advance the next railroad and pay the owner double, and so you get this nice windfall. And I think there's a little windfall coming in high quality fixed income at some stage when the economy falls into recession. And that's a particularly useful time, because that will be when the stock market's taking a hit too. So I do think the diversification benefits of fixed income have been renewed here. And ultimately, I think long rates will be somewhat lower than they are right now. I don't think they'll be a lot lower, but I could easily see us sort of settling in the long run to about a 3.5% rate, 3 to 3.5% on a 10-year Treasury, because I think in the long run, this is not an inflationary economy. I expect the Federal Reserve is going to spend more time in the coming years trying to get inflation back up to 2% than trying to get it to come down to 2%. And that does give you a good long-term outlook for interest rates.
Yeah, that's really helpful. Switching gears and looking abroad, we've had a number of questions on China, and I'd love for you to touch on China. Yeah. The Chinese economy appears to be transitioning from a more of an export-led economy to one that's that they're trying to drive more consumer spending internally within the country. Growth this year is clearly disappointed. Is that partly, do you think, a function of that transition away from the export-driven economy? And then what are, sort of longer term, the implications, do you think, for the US economy and more broadly the global economy?
Yeah, so I think that was the Chinese plan. And it makes sense because, after all, China had grown tremendously, exporting to the rest of the world. But the rest of the world didn't much like the fact that Chinese companies were basically costing them manufacturing jobs. And if the Chinese economy is big enough, you just can't get enough growth out of export industries to really keep the thing humming along. So they were always going to have to transition to an economy which had more of a domestic dynamo to it. That was always going to happen. I think but two things sort of got in the way of this grand plan to transition from an export-led, investment-led economy to a consumer-led domestic economy. One of them was the pandemic, which I think really has shaken confidence within China, within the Chinese population. I think being more isolated, having to put up with government edicts, and I'm not trying to get into the issue of lockdowns before you got vaccines, but China was very austere in terms of, even if you had been vaccinated, we had huge lockdowns last year, and that zero COVID policy was seen by the Chinese public as being extreme. But also over that period of time, Xi Jinping, consolidated his power. He is very much the autocratic leader of China right now. It's not really being led by a Politburo so much as by one person. And he also decided that there were a lot of things that he was going to reform as part of his own vision of how China should be run. So he tried to get rid of private education. He tried to do, some things that I would kind of agree with, like getting rid of mining for Bitcoin, which I think is rather a good thing. But there are a lot of other things which were cracking down on various parts of technology in terms of information flow in the economy. Also trying to crack down on speculation in housing, which I'll come back to. But I think all that interference by the government in what had been a gradually opening up economy has really undermined the entrepreneurial spirit of the Chinese people. I think they're worried. We could have a little business going and we could make lots of money, and then suddenly the government changes its mind about how it likes to shape the economy, and so we're in trouble. And I think that has revived old fears within the Chinese public, which of course has had to put up with communist governments since the 1950s. So I think that is, I think that has really undermined confidence. And then you've got the whole issue of real estate. Now, the Chinese people, and indeed this is true actually for many countries outside the United States, they're not huge investors in the stock market really, or in the bond market or other assets. Their net worth is tied up in real estate. And they were going real estate crazy. Everybody's, people, you couldn't get married unless you owned an apartment, but you buy an apartment, then you buy another apartment for investing. And so we saw massive building of apartments, and we've got a huge number of vacant apartments in China, in a country in which, by the way, the population is now shrinking. And so we've got a huge excess supply. But the problem is the value of these apartments is enormous. I mean, these are some of the most expensive cities in the world to buy an apartment. We've got grossly inflated prices with not enough demand. We've got real estate developers going bankrupt and leaving people who bought houses under construction basically with something that's half finished and all the money tied up in it. And so this is really hammering away at the wealth of Chinese people, even more so than had happened in the United States in the great financial crisis. I mean, yes, that happened and it caused tremendous disruption, but at least in the US, people have their 401ks in the stock market, which bounced back. They don't have that in China to the same extent. So what that's done is it's caused consumers to really pull back more. And I think China's got a very difficult problem. How do you get Chinese consumers to spend if they are scared that they're not going to have enough money for their old age? And I'm a little haunted by the fact that was kind of a question you could have asked 35 years ago in Japan, which had also a real estate bubble which burst in 1989, and then real estate prices came down for years and really haunted and it caused deflation in Japan. And there's a similar sort of mentality about savings there. So it's really, I know this is a long answer, but it's really hard for China to regain the confidence, both the government regaining the confidence of people and the people regaining the self-confidence to invest and spend after the pandemic and after some of the more authoritarian moves that Xi Jinping has taken, and after the value of the biggest asset for most Chinese households has started to go down.
And then turning domestically into fiscal policy here, we get a lot of questions on the US debt and the amount of debt outstanding. We've long said it's less about the absolute level of debt outstanding and more about the ability to pay that debt. Effectively the interest coverage ratio for the government. Are you concerned about the debt outstanding? And if so, what's the solution, if any?
Well, I'm not terrified by it. I mean, I think there's the debt as a share of GDP peaked at about 100% of GDP a few years ago. It's actually coming down a little bit now, but it's still high. It's in the high 90s, which is much higher than it was before the pandemic, and much, back in the year 2000, it was only 33% of GDP. So it's gone up a lot. But it does appear that around the world, people still want to buy U.S. Treasury bonds. So it's not, we're not having a problem financing this level of debt relative to the size of our economy. It is, the deficits right now are rising, but they're rising in part because the Federal Reserve is being so aggressive in tightening monetary policy. But as I said, sooner or later, the Federal Reserve is going to, the economy is going to slip in a banana skin. The Federal Reserve is going to cut rates. And if, I said in the long run, I thought a 10-year Treasury yield of 3.5%, a federal funds rate, I'm going to take the Fed's word for it, 2.5%. That means that there should be a reasonably low cost of financing the debt in the long run. So I think that gives us time. Perhaps we don't deserve time, given the way we run things, but I think it does give us time. How do you get the debt down as a share of GDP or get the deficits down to zero? Well, you just need a better political system. You need people to get elected, people who tell the public the truth about spending and about taxes. But what happens on both sides is people, one side says, well, we will never raise taxes, and another side says, well, we have to increase government spending, and we're going to call all government spending investment. And both sides are really not squaring with the American public on this, but the American public really has a responsibility to elect people based on sort of, the way you would elect, if you were in a company and you were electing somebody as your chief financial officer, you'd never put somebody in the position of chief financial officer who were telling you the kinds of fibs that both sides are telling the public today. But until we grow up as a voting nation, I'm afraid this problem will get worse. It's not imminent. It's not going to cause an imminent crisis, but it will, in the long run, impoverish us as a nation, and it won't fix any of our problems in terms of inequality or political polarization or lack of productivity growth. So I think people don't realize how badly served we are by our political system, but I still don't think it's going to cause a crisis in the short run.
Yeah, that's helpful. Thanks. And final question here. I'm conscious of the time, but and maybe if we wrap that up with the economic backdrop and outlook that you've outlined to us, with an asset class outlook here, where we believe that we've already entered a structural shift with respect to monetary policy, where the years post global financial crisis were really marked by easy policies, low interest rates, quantitative easing. In the years ahead, it's likely to be higher interest rates relative to those years. Even if the Fed gets back to their 2.5% stated goal, it's still going to be higher. And I think what's not really focused on a lot is quantitative tightening. They are adamant that we will continue to shrink their balance sheet. So to some degree, that may offset some of the interest rate cuts in the future. So with that backdrop, we're expecting over the long haul more moderate returns out of the stock market relative to those really gangbuster returns we experienced up to the end of 2021. But where we are more constructive, I think, is within the bond market, where we are getting, and you alluded to this, mid to high single-digit rates of return with high-quality asset underlying bonds. And then another area is alternatives, where we've been allocating more of our client portfolios towards alternatives, private equity, direct real estate, direct credit in particular, where we see upside potential in terms of risk-adjusted returns. So what's your outlook for, briefly on stocks, bonds, and then alternatives? I know you touched on all three of those during the course of the presentation.
Well, yeah, I think we have a very similar outlook. I mean, first of all, I do think the Federal Reserve will cut rates back down, but I think they have learned their lesson. So we're not going to see a period of 0% rates for a long period of time like we did for many years after the Great Financial Crisis. I think they realized that was a mistake. I don't think we're going to get there again. So I think there is a limit to how low rates will go. I think that does also put a limit on how much speculation you can get away with in the stock market. And I think it will hurt things like Bitcoin and cryptocurrencies, I think will generally have a pretty rough time when given that you actually have to borrow real money to finance a fling in these areas. So I think we have to be pretty cautious about equities overall. I will say I think that international equities look a little cheaper and maybe have a little bit more promise than US equities. I think within the fixed income market, I agree with you. This is one of those rare times where you've got relatively high yields, and if you've got high yields and you think inflation is going to come down, then you can get some decent returns. So I think that is also true. With regard to alternatives, I think you do need good managers. I think it's you need to have. It's a very heterogeneous space. There are a lot of good managers and a lot of bad managers, and it's and there are also lots of different types of assets. I mean, that's why they call them alternative assets. But in general, I do think that there's opportunity in real assets, particularly if you can find the right ones. For example, in real estate, we know there's a problem in office. We know there's a problem in sort of second tier, third tier retail. But in the best retail properties, there's a lot of opportunity. There's a lot of opportunity in the investment spending that's taking place to build data centers for AI or to build buildings that comply with clean energy standards or cleaner standards. So there are plenty of opportunities there. There's going to be a huge need for green infrastructure. I think there's opportunity there also. I think this is a time where over time we've seen the stock market is playing a slightly different role than it did traditionally. It used to be much more of a entrepreneurial stock market. I think that the space occupied by private equity has grown, and the space occupied by the sort of secondary market for equities has shrunk. And so I think a lot of the fastest growing companies and best ideas for the future can be found in the private space. So I think it's important as part of diversification to have some exposure there. So overall, I think that's I think it's as I say, I think we're very close in terms of our view. I would emphasize that, and I know this is why, we both very much believe in financial planning, is it's so important to just think about the opportunities and the risks in the context of where you are in life. What is it that you want to do? What risks should you really be willing to take? How many years is it going to be before you spend the money? Are you a worrier, or is it something that can you sleep just fine knowing that your money is going to be okay in the long run, even if you get some short-term volatility? And so it's really, fitting a portfolio to you and to where you are in life, which is really just as important as understanding both what's going on in the economy right now, but also in the opportunities in different asset classes in general.
Yeah, absolutely. Couldn't agree more. Well, thank you so much, David, for your time today. It was an absolute pleasure to have you share your expertise with us. And thanks everybody in attendance. You definitely covered a lot of important information and topics that are top of mind for many investors.